Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, let's just jump right in. We're looking at one of the most polarizing stocks in the digital asset world, DeFi Technologies, Inc., ticker DEFT. We've all seen its market cap just whipsaw wildly. Recently, it's bounced between, roughly $286 million and $418 million in just a few weeks. That kind of volume, that kind of action, it points to a really deep tension. And that's really the question for today, isn't it? Is DeFi, trading so close to its cash value, a genuine asymmetric bet with, say, 5x upside? Or is that discount a massive red flag for some really serious structural problems?
That volatility isn't just noise. It's a stock's whole structure, screaming instability.
I understand why it looks like pure instability, but let me lay out the bull case. My position is simply that DEFT is, right now, severely undervalued. It has a robust balance sheet, and this is the critical part. Its leverage profile, a beta of 4.05, makes it, sort of the ultimate vehicle for a potential crypto bull market. We are looking at a huge asymmetric reward profile here.
And I'm on the other side of that point. That discount isn't an opportunity. It's what I'd call a completely justified trust discount from the smart money. The evidence to me, it overwhelmingly points to a fundamental and I think permanent collapse of their core trading engine, that whole supercharger idea. You combine that with some very acute legal and structural fragility, and this stock just becomes, toxic for any serious institutional buyer.
Okay, but let's look at the hard assets for a second. The current valuation is, frankly, punitive. It completely ignores the intrinsic value here. As of Q3 2025, DFT had something like $165.7 million in total liquid treasury assets. And of that, $119.5 million was just pure cash. When you think about a market cap that's been dipping towards $300 million, that treasury provides a remarkably solid floor. It's a huge cushion. And that's before you even get to Valorinx, their established revenue-generating arm with nearly $990 million in assets under management.
That treasury is a seatbelt, I'll give you that. But a seatbelt doesn't do you much good if the car itself is fundamentally unstable. You're focused on the asset side, but you're ignoring the pathology on the income statement.
But the valuation gap is just staggering. The market's pricing DEFT like it's a distressed asset, like it's about to be liquidated. It's trading at only about 1.7 times enterprise value to revenue. For our listeners, that is extremely low for this sector. And when you compare that to regulated peers in Europe like CoinShares, which trades at a much higher multiple because of that perceived stability, the gap suggests a huge undervaluation. Just closing that trust discount could lead to a 50 to 100% re-rating almost overnight.
That re-rating is a big if. I'm sorry, I just don't believe the cash and AUM alone can make up for the operational rot. And let me tell you why. That optimistic view, it conveniently sidesteps the catastrophic failure of their main proprietary trading business. We saw a disastrous 47% revenue guidance downgrade for fiscal year 2025, slashed from $218 million down to $116 million.
It was an adjustment to market realities, not a catastrophe.
The company's official line, a delay in executing DeFi alpha arbitrage opportunities, is, let's be honest, corporate jargon for the easy money is gone. The evidence points to a structural degradation of that arbitrage model. The material itself says that a proliferation of competing DAD companies has just flooded the market. Spreads got compressed. The whole arbitrage engine, the very thing their premium valuation was built on, has collapsed. The supercharger is, it's out of gas.
That's a fair point about market efficiency getting tougher, though I wouldn't call it terminal. Market efficiency always compresses abnormal returns, but that doesn't mean the company's dead in the water. Every single revenue source in crypto is evolving right now. Why is this specific shift uniquely fatal for DeFi?
Because they sold the entire story based on that supercharger thesis. Now, DEFT is basically just becoming a much lower margin ETP provider. It's reliant almost entirely on Valor's fees, which range from 0 up to only 1.9%.
The days of those high-margin proprietary returns are based on their own numbers demonstrably over.
But what about the other risks you mentioned? You keep bringing up legal issues and governance as these deal breakers.
Exactly. The governance is terrible. You've got very low insider ownership, somewhere between 2 and 5.5%, and then you have net insider selling of over $600,000 leading up to early 2026. If the people with the best view of the company, the captains of the ship, are selling stock, that's a huge vote of no confidence. And on top of that, you have this very real liability hanging over that, an active securities class action lawsuit. That lawsuit validates the whole bearish story, and it basically puts up a wall that keeps institutional money out until it's resolved.
Okay, so we found our core disagreement. Is the Q3 2025 decline a permanent structural break, or is it a temporary setback that management can pivot away from using its cash?
Based on the numbers, Q3 revenue dropping to $22.5 million from $28.1 year over year, and the company's own language, I'd argue it's permanent. They are, at best, now just a sort of unexciting asset manager that happens to be sitting on a pile of cash. The high-growth, high-margin story is functionally over.
I do acknowledge the setback in the DeFi Alpha division was significant. And yes, arbitrage spreads are tighter, but I'm just not convinced that's the end of the story. To say they can't adapt is to really underestimate the value of that treasury. The company has already shown it can make strategic changes. They're expanding their product roadmap. Look at the planned launch of Valor Custody in 2026. That shows they're not just sitting on their hands, they're trying to reposition.
Repositioning costs a lot of time and a lot of money, and I imagine their legal bills aren't small.
But they have the capital to do it. They can deploy that $165 million into other high-yield strategies that could replace the lost revenue. I mean, think about things like staking, or maybe more interestingly, MEV extraction.
Hold on. Let's just clarify for everyone what MEV extraction actually is.
Sure, absolutely. MEV, or maximal extractable value, it's essentially a way of capitalizing on transaction ordering on the blockchain. It's a very sophisticated form of prop trading that generates yield. If DEFT can successfully pivot even a part of that treasury into a robust MEV or staking operation, they could rebuild a high-margin revenue stream. The core asset gathering business, Valor, stays intact. The real upside comes from what they do with that cash.
They can execute on a far more complex and frankly already competitive one like MEV. Let's move to the second big point, which I think is the most dangerous part of this stock, the volatility. You frame that high beta 4.05 as the main driver for your 5x upside scenario.
Exactly. That's the entire thesis. If we get a real crypto bull market, let's say Bitcoin hits $150,000, maybe $200,000, that 4 times beta could theoretically drive the stock up 400 or 500%. It is absolutely high risk, high reward, but the structure is perfectly built for an explosive move. The market is giving you leveraged exposure to the whole crypto space at a bargain. That's a phenomenal asymmetric opportunity.
And I see it from the exact opposite perspective. That high beta represents an unacceptable level of systemic risk. The cash floor you love to talk about is a seatbelt, sure, but a beta of 4.05 means you're driving a Formula One car on a cliffside road. The forces are just too extreme. The stock's correlation to Bitcoin is high, yes, 0.85, but it's also highly correlated to the broader tech market. It trades like a speculative tech stock.
Well, that's just macro risk. Every tech company has that.
It's magnified macro risk. If the NASDAQ has even a modest 10% correction, a totally normal event, a beta of 4.05 implies DeFi stock could theoretically drop by 40%. A 40% drop completely vaporizes that safety net from the cash treasury for anyone buying in at today's prices.
But is that really a company-specific problem?
The company structure makes it worse. The analysis shows that 85.5% of the shares are public float. That means it's overwhelmingly retail investors, momentum traders. That float does not have sticky hands. They don't have the discipline to absorb real selling pressure. So when the NASDAQ corrects, retail panics, they sell, and that 40% drop you talked about happens fast, trapping everyone who thought the cash was some kind of guarantee.
That volatility and the skepticism you're outlining, it actually leads perfectly to our last point, market sentiment and the shorts. You're right, this is a battleground stock. The short interest ratio is high, 4.58 days to cover. And that 48% off-exchange short volume, that definitely confirms there's a persistent institutional bearish view.
DEFT. This is serious capital that believes the story of operational failure. And let's not forget the reputational damage from the CoinSnacks short and distort allegations. That was ugly. It painted the company as potentially fraudulent, and that kind of stain, it sticks. It keeps conservative capital away.
Okay, I acknowledge all of that. But the high short interest, I think it pivots from being a bearish sign into a potential bullish catalyst in this very specific case. That 4.58 days to cover, that's the key.
A short squeeze is a lottery ticket, not an investment thesis.
It's a mechanism that is unique to this stock structure. Almost 5 days to cover is high enough to create real squeeze conditions. So if a positive catalyst hits, maybe a quick, favorable settlement of that lawsuit, or a big, sustained move in Bitcoin that pushes the stock up 20% fast, the shorts would be forced to cover all at once. That sudden wave of buying demand is what creates the parabolic move. It amplifies the volatility you're worried about, but in the upward direction, creating the exact conditions for that 5x scenario.
So you're relying on a highly conditional, outside event, a squeeze, to fix a demonstrated internal structural failure. You're not investing in the business, you're gambling on market mechanics.
I'm investing in the structural leverage that the cash floor and the high beta provide, which is then amplified by the short interest. The market has already priced in all the bad news, the guidance cut, the lawsuit. So any good news, any resolution, or just a big crypto macro tailwind acts like high-octane fuel for an explosive recovery.
And that all depends on whether you think management can actually pull off this pivot to staking and MEV before the market just gives up on them entirely.
So, to summarize my position, DEFT is in the penalty box. It's being unfairly punished for an operational miss and a legal issue. But this has created a really compelling asymmetric risk-reward setup. The AUM and the Treasury provide a clear, if limited, cap on the downside. And more importantly, the high beta means the upside potential, that 5x return, it far outweighs the risks as long as the crypto macro environment holds up and management can execute this pivot. It's high stakes, deep value.
Completely speculative. The market isn't wrong here. It's correctly applying a trust discount because of the proven collapse of their high-margin business and that active legal problem. Investors have to weigh the limited protection from the cash against the very severe, very tangible risk of a major sell-off triggered by its beta, its NASDAQ correlation, and its fragile retail investor base. The downside, as we said, is just as leveraged as the upside.
The verdict then really depends on whether you believe the external crypto cycle can overwhelm the internal structural weaknesses before those weaknesses cause terminal damage.
Which leaves us to decide if DEFT is a deep value play for investors willing to take on massive execution risk, or if it's just a highly leveraged speculation on the next Bitcoin halving cycle. There's certainly a lot more to dig into there, especially on the specifics of that lawsuit and their new product plans.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.